Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we began our discussion on the carry trade with a look at how traders use this strategy to take advantage of interest rate differentials between different countries. In today's lesson we're going to continue this discussion with a look at the role that leverage plays, as well as by looking at some of the things that traders look out for when implementing this strategy. So let's get started.
As we saw in yesterday's lesson, if a trader buys the New Zealand dollar-US dollar currency pair, then as of this lesson, they will earn $10 per contract held past 5 p.m. New York time on Monday, Tuesday, Thursday, and Friday. As we learned in our lesson on rollover in Module 2 of this course, they will earn 3 days worth of rolls or $30 on Wednesday to take into account Saturday and Sunday when the market is closed. This brings the total interest paid for the 7 days in the week to 7 times 10 or $70. As there are 52 weeks in a year, if a trader held this position for the entire year and the rollover rate did not change, they would earn 70 times 52 or $3,640 in interest from the rollover portion of this trade. At the current market rate for the New Zealand dollar-US dollar as of this lesson of 0.7687, this is an annual return from just the rollover portion of the trade of 4.7%. This, of course, makes the large assumption for simplicity's sake that the exchange rate and the rollover rate will remain the same as they are today for the 1 year period that the trader is in the trade. Now, you may be thinking to yourself at this point, well, Dave, I was kind of excited about the whole carry trade thing and was seeing how it was so popular until I see a 4.7% return plus all the caveats. To be honest with you, this does not get me too excited, and I don't really see why this is all that popular. As some of you may have already realized, however, if we were to utilize some of the leverage that is available to us in the Forex market, as we learned about in Module 2 of this course, then we might be able to take that 4% return and juice it up into something a little more interesting. So with this in mind, let's say I leverage this position 2 to 1, which I think most traders would agree is still pretty conservative. This would double the return from the rollover portion of the trade to 9.4%, a return that, if generated consistently, would be in the neighborhood of the long-term average return of the U.S. stock market. Taking this a bit further, if I increase the leverage to a more aggressive 3 to 1, that would put my return from rollover at 14.1%, and if I up the leverage to an even more aggressive 4 to 1, that would put me at 18.8%, a return that handily beats the average long-term return of the U.S. stock market. When people first see this, many times their initial reaction is one of excitement, which makes them want to jump right into a trade. As with most things, however, if making money was this easy, then everyone would be a millionaire. So while this is an enticing return, and while there has been a lot of money made by people employing carry trade strategies, there are other things to consider. The first thing is exchange rate fluctuations. Exchange rate fluctuations can cause additional profits or wipe out all the profits and cause actual losses on the trade. Number 2 is changes in interest rates. Basically, changes in interest rates can increase the positive rollover, decrease it, or cause a trader to end up paying for holding the position instead of earning. Lastly is the use of leverage. Anytime leverage is used, it amplifies any gains made on the strategy, but also amplifies any loss should the trade begin to work against the trader. It is how traders deal with these unknowns that separates the traders who consistently make money with carry trade strategies from those who do not, a topic which we will discuss in our next lesson. That's our lesson for today. As always, if you have any questions or comments, please feel free to leave them in the comment section below, and good luck with your trading.